If you own a home in Canada, you are sitting on a tax advantage most homeowners have never been told about. The CRA has a rule. Mortgage interest is not tax-deductible. You earn money, you pay tax on it, and then you hand the after-tax dollars to your bank as interest every single month. But here's what almost nobody in Canada knows. There is a completely legal, CRA-approved strategy that lets you convert that non-deductible mortgage interest into fully tax-deductible investment interest. It's called the Smith Manoeuvre, and if you own a home in Canada and you've never heard of it, this video might be the most valuable 9 minutes you spend this year. I'm going to show you exactly how it works, step by step, the specific mortgage product you need, and the real math on what this is actually worth. Quick disclaimer. I'm Sebastian, this is Canadian Finance, and this is education, not financial advice. Talk to a professional before you do anything with your money. Cool, let's get into it. Before we talk strategy, we need to rewire something, because every Canadian is raised with the same financial commandment: pay off your mortgage, get out of debt. Debt-free is the goal. And look, I get it. Debt feels bad. We're wired to hate it. But here's the thing the CRA actually tells us, and most Canadians never read this far. The CRA doesn't view all debt equally. They put it into two categories: bad debt and good debt. Bad debt is money you borrow for things that don't generate income. Your car loan, your credit card balance from that trip to Banff, and yes, your mortgage, because your house doesn't generate taxable income. You live in it. The interest you pay on your mortgage is pure after-tax money going straight to the bank. Good debt is money you borrow to invest in something that generates income. Dividend stocks, an ETF portfolio, a rental property. Because you're trying to earn taxable income, the CRA lets you deduct the interest cost from your taxes. The Smith Manoeuvre is a conveyor belt. Every single month, it moves a chunk of your debt from the bad pile to the good pile. You are not paying off your debt faster, you are converting it, painting it green. And stick around, because at the 6-minute mark, I'm going to show you the flywheel effect that lets people pay off a 25-year mortgage in 12 to 15 years. It's the part most people can't believe is legal. Now, can you do this with your current mortgage? Probably not. Most Canadians have a standard amortizing mortgage. You make your payment, the balance goes down, the equity sits trapped inside your walls until you sell. That equity is doing nothing for you right now. To run the Smith Manoeuvre, you need one specific product. It's called a readvanceable mortgage. Here's how it works. Your total borrowing limit is set at 80% of your home's value. Let's say that's $640,000. That limit is split into two parts. Part 1 is your mortgage, the amortizing loan that goes down every month. Part 2 is a home equity line of credit, or HELOC, a revolving credit line. In a standard setup, you'd have to apply to access that equity. In a readvanceable mortgage, these two parts are linked like a seesaw. Every time you make a mortgage payment and pay down, say, $1,500 of principal, your HELOC limit automatically increases by exactly $1,500. Instantly. No application, no waiting. That automatic readvanceability is the engine of this whole strategy. Without it, the friction is too high and it falls apart. The major Canadian banks, TD, RBC, Scotia, and BMO, all offer versions of this. Ask specifically for a readvanceable mortgage, not a standard HELOC, a readvanceable mortgage. Okay, you have the product. Here's what you do every single month. 5 steps. Don't blink. Step 1. Your regular mortgage payment comes out. Let's say it's $3,200. Of that, maybe $1,400 is interest going to the bank, and $1,800 is actual principal paydown. That $1,800 is the number we care about. Step 2, you log into your banking app. Because you have a readvanceable mortgage, your HELOC limit has automatically increased by exactly $1,800. Step 3, you borrow that $1,800 from the HELOC and transfer it to your checking account. This is the moment the clock starts on your tax deduction. Step 4, you move that $1,800 into a non-registered investment account. And I need to be really clear here. Not your TFSA, not your RRSP, a taxable, non-registered account. This matters legally. Step 5, you invest it, and what you buy matters. The CRA requires assets with a reasonable expectation of income. That means dividend-paying stocks, ETFs that pay distributions like EQTT or VYDY, REITs, rental properties. Not Bitcoin, not gold bullion. Income-generating assets only. At the end of the month, the HELOC charges you interest on that $1,800. Let's say it's $9. You pay that $9, and because that $9 was spent to earn investment income, it is 100% tax-deductible. You have just converted $1,800 of bad debt into good debt. You do this every month, 12 times a year, for decades, and the numbers get very interesting very fast. Here's where it gets really good, and this is the part I teased earlier. Fast forward to the end of year 1. You've been doing this for 12 months. Your investment loan is now around $22,000. You've paid roughly $1,100 in HELOC interest across the year. When you file your taxes, you deduct that $1,100 as an investment interest expense. If you're in a 40% marginal tax bracket, and a lot of working Canadians are in that zone, the government sends you a check for around $440. Now here's where most Canadians make a mistake. They take that $440 and spend it. New hockey gear, a weekend in Niagara, gone. The Smith Manoeuvre investor takes that $440 and makes an extra prepayment on the mortgage. Watch what happens. The mortgage drops by $440, the HELOC limit rises by $440, you borrow that $440 and invest it. Next year, your deduction is slightly bigger, your refund is slightly bigger, the prepayment is slightly bigger. This is the flywheel. The refund pays down the mortgage paydown creates HELOC room, the HELOC room creates a bigger deduction, the bigger deduction creates a bigger refund. Round and round, every year faster than the last. This is how people pay off a 25-year mortgage in 12 to 15 years while simultaneously building a 6-figure investment portfolio, using the same dollars twice. Let me put a real number on this so it stops feeling abstract. Take a homeowner in Ontario with a $600,000 mortgage at 4.5%, 25-year amortization in a 43% marginal tax bracket, which is pretty typical for a household earning between $100,000 and $150,000. Without the Smith Manoeuvre, they pay off the mortgage in 25 years. Total interest paid to the bank, roughly $390,000. Investment portfolio at retirement, whatever they manage to save separately. With the Smith Manoeuvre, running it properly with the tax refund flywheel, the mortgage is gone in approximately 13 to 15 years. Total tax refunds received over the life of the strategy between $18,000 and $24,000. And the investment portfolio built entirely from converted equity and reinvested refunds, somewhere between $400,000 and $600,000, depending on market returns. Same income, same house, same mortgage, completely different financial outcome because the debt was converted instead of just paid down. That is not a small difference. That is the difference between retiring with nothing outside your home equity and retiring with $500,000 in an investment portfolio. Now, and this is important, the CRA has very specific rules here and you need to respect them. You can only deduct the interest if the money is invested in assets with a reasonable expectation of income. Income means dividends, distributions, or rent, not capital gains. Greenlight list, Canadian dividend stocks, broad market ETFs that pay distributions like EQTT or VYDY, REITs, rental properties. Red light list, Bitcoin, gold bullion, growth stocks that pay zero dividends. These pay no income, so the interest deduction will be denied. Don't go there. And the golden rule, no registered accounts. Do not put Smith Manoeuvre money into your TFSA or RRSP. You cannot deduct interest on money borrowed to make tax-free income. The CRA will not allow it, and you will have an uncomfortable conversation with them if you try. The risks. Because this is leverage, and leverage cuts both ways. Risk 1, a HELOC is a demand loan.
Read your contract. The bank can technically call the loan at any time. In practice, they almost never do this as long as you're making payments. But if Canadian housing prices drop significantly and your equity evaporates, the bank can freeze your HELOC. If that happens at the same time the market drops, you could be forced to sell investments at a loss. The solution to both risks is simple. Keep a cash buffer. 3 to 6 months of living expenses in a high-interest savings account like EQ Bank. Your emergency fund is not optional when you're running leverage. It's the seatbelt for this strategy. Here's the bottom line. Every Canadian homeowner who pays mortgage interest and also invests should know this strategy exists. Whether it's right for your specific situation depends on your income, your home equity, your risk tolerance, and your discipline. But the homeowner who doesn't know about the Smith Maneuver is handing the CRA money they were never legally required